You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we're back once again. It's Education Wednesday. Time for your double dose of options education. Kicking things off today, of course, the one, the only Options Bootcamp, the premier educational program for all of you out there who want to learn a thing or two about them, their options. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this network. And glad to see so many of you are enjoying the newest additions to the network. Seems like it's been around forever. It's only been a little over a week now that we announced them. Options Insider Plus, Options Insider Pro. Those of you here listening to the Options Bootcamp feed, you got a special surprise bonus episode in your feed. Yesterday, we did our first ever Pro question and answer, a Pro Q&A session with the Oracle of New Hampshire himself, Mr. Matt Amberson from ORATS, talking all about trade structure, back testing, the proper way to set up and structure your trades. Hopefully you guys are able to join us live. If not, we put it in as a fun bonus for you folks there on Options Bootcamp, because I know so many of you have so many great questions. So check that out on the feed when you have a chance. If you like those, if you want to participate in those going forward, visit theoptionsinsider.com. Click on that little cart icon. Just go to optionsinsider.com/shop. And that'll have all of the information there about how you can participate in those sessions going forward. Lots of cool stuff. Glad to see so many of you in there, and hopefully you'll see more of you there as the time rolls on. And joining me here on the program today, the black-hatted one himself. He's doing his best to battle against the internet gods today. He is none other than Mr. Dan Passarelli, the founder of Market Taker Mentoring and author of one or two options-oriented tomes. Mr. P, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
Hey, it is great to be back, Mark. Let's do this thing.
All right, let's do it before the internet gods get a whiff that you're back online as we keep on rolling right on into a little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out. Do you hear me? Yes, sir. Basic to complex. Yes, sir. There will be no failures. Do you hear me? Yes, sir. Pull in. Yes, sir. Prepare to learn. Yes, sir.
All right, Mr. P, let's get right down to business. Let's do it. A lot popping off in the world of options. A lot of things moving hither and yon. A lot of things decaying a little bit as well. And of course, I know you guys over there at MTM put out a regular options newsletter for your mentees. And a recent subject of that newsletter caught my eye. And it seemed like it would make a good addition to the show, a good time to revisit this subject. We went into Delta recently and a few other topics, and it seems like a good time to revisit that other Greek that doesn't get discussed a lot, but is oh so important, especially for a lot of our premium harvesters out there. Yes, we're talking about Theta. Mr. P, as the guy who literally wrote the book about the options Greeks, and as well as the person who's put out the newsletter on this. I'll let you run with this first. Obviously, Theta, an important Greek. Maybe let's start by a quick breakdown of, for all of the complete neophytes out there, what the heck we're talking about. Then let's get into some of the subjects you were talking about recently in your newsletter about how you like to incorporate and how a lot of our listeners can incorporate Theta into their options trading, sir.
Yeah, Mark. So look, options are the right to buy or sell the underlying stock, right? And so intuitively, the longer you have the right to be able to do that, the more chance there is for the stock to move and for that right to be valuable. So the more time to expiration there is, the more an option is worth. So consequently, as time passes, the option gets worth a little bit less in value every day. So that's called time decay. And, you know, being option traders, I mean, this is money, dollars and cents. You know, you make even a couple of pennies on many contracts and it adds up. So we need to be able to measure that time decay really, really accurately. And that is what Theta does.
Yes, it's one of those Greeks. You know, people always talk about delta, they talk about vega, they even talk a little bit about gamma, but gamma and theta, kind of two sides of the same coin. You can't really get a lot of one without getting a dose of the other. So as Dan mentioned, this is, of course, I had a cohort in one of my programs back in the day, used to say options die a little bit every day. And it may sound hyperbolic, but it's true. And Theta is the way to measure that death, a little bit of a death by 1,000 cuts, unless it's something crazy. Then it could be cutting the jugular vein, but we'll get to all that in a little bit. So let's break it down, Dan. Theta has a lot of different components to it and also a lot of different ways that it performs, you know, out of the money versus in the money. I know you guys went deep into this recently with all of your mentees. So why don't you give a cursory overview for our listeners here, sir? Let's dive into Theta. Let's talk about some of those different ways that it performs at the money versus out of the money and all that fun stuff, sir.
So when it comes to option trading, the more you learn, the more you earn. And so getting to know those little nuances of Theta makes such a huge, gigantic difference. And so, like, if your whole game is selling options and wanting options to get worth less, you want them to get worth less fast, right? You want your trades to need to hold them for the least amount of time possible. You want them to work for you as efficiently as possible. So here's a couple of tips and tricks that'll help you make the most out of your option selling. First, at the money options tend to have the highest theta. That means if you short them, you make money faster. Out of the money and in the money options have lower thetas. Also, shorter term options tend to have higher thetas. That means if I sell, the way I like to say it is if I sell 4 1-week options 1 week in a row, and just roll them every expiration Friday right before the bell, I'm going to make more, probably a lot more than if I sell 1 4-week option because those shorter term options have higher thetas. So those are 2 really great rules of thumb. And if you know that and stick with that, you're going to be doing great.
Yeah, those are very important to keep in mind. Obviously, if you're looking at, let's start from the dark side, selling options out there. If you're doing a lot of your premium far away from at the money strikes, you may be surprised. Like, why is it taking so long for these options to decay? It's because at the money, it's the furnace. It's where the fire burns the hottest there. So if you're selling and migrating a lot of your liquidity around the at the money strikes when you're selling premium, you're going to see a lot of that decay kick in a lot faster. Also, something to point out, something to keep in mind, decay and theta, you're going to see it quoted as a number. We're going to go through an example in a little bit. Just bear in mind, these Greeks are a moving target. Theta is going to change over time. And also, as you approach expiration, you're going to see that decay accelerating. So that's why we always say migrate your liquidity on the short side. We were just talking yesterday in our pro Q&A session about structuring collars the right way. And on the long put side, you want to push it out a little bit farther to try to stave off some of that decay. And on the short call side, you want to put that close as expiration as possible. And the weeklies are definitely in the monthly, not much beyond that, because you want to maximize the impact of that exponential increase of theta as you get closer to expiration. In fact, when we first walked on the floor of the SIBO, I'm sure, Dan, you had the same problem. We used to have machines and then sheets, all these kind of things to calculate your theoretical values. And when you got to the big day, which was expiration Friday, which is kind of a misnomer now, every weekend and every Friday is expiration Friday, really. But they would say, hey, just throw those sheets, turn your machines off, because nothing really makes sense for the Greeks on that final day of expiration. The gamma was a meaningless number. The theta it would show you 8 million, something absurd, because it was accelerating so quickly and changing so rapidly that it literally couldn't calculate it anymore. Theoreticals have come a little bit of a ways since then. They're a little bit better at handling that, but still, towards those last moments of an option's expiration and option's lifespan, that's when things get crazy from a theta and from a gamma perspective. Also, let's talk about a couple of things now. When's theta positive and when is theta negative? Dan, people think of theta and they think time decay. It's a bad thing. It's going to hurt me. But that's not always the case, is it, sir?
No, it's not, Mark. Selling options is, sell high, buy low. Just reverse that order. And when things get when I sell something short and it gets worth less, that's a good thing. And selling options is very, very common. It's equally as common as buying options.
Yes, people are maybe used to looking at their P&Ls and seeing theta as a negative number because they're paying it every day if they're long options. But if you're selling options, you're going to see that sign flipped around. It's a nice thing. It's a positive thing. It's a happy friend when you're selling options, and you want it to come much faster then. Again, going back to those old days on expiration Friday on the floor, you could tell the people right away who were short a lot of theta, they were collecting it, and who were long a lot of theta, because the people who were short, they weren't that happy that last day, because remember, everything was exploding. It was exponential, and every little tick of the underlying, they were collecting, but they were sweating for it. They had to earn it. They were popping their tums, and they were not looking pretty good until the end of the day. So they had to work for it sometimes. And if you're selling options, you can probably commiserate with that. You probably had those moments where it kind of moved against you a little bit, and you had to sweat it out before you had the underlying and the options move your way. Let's break down some examples. Again, check out Dan's newsletter. He'll mention how to subscribe to it in a little bit, because they had some great visuals that went along with that. But effectively, if you pull up your options chain, you're going to see a lot of different numbers. If you have a good broker, you're going to see a lot of different numbers. You're going to see your vol, and you're going to see your Greeks, hopefully, your delta, gamma, your theta, and your vega. They're typically going to quote your theta in some sort of monetary increment that you could probably make sense of. So an example Dan had here in his newsletter, that you were buying a call. It was a 120 strike call expiring in 44 days at the time of this, and it was worth $9.75, so a bit of a rich call. And the theta was quoted as right around 0.05, so effectively meaning you're paying 5 cents a day, a nickel a day in premium. So pretty straightforward. You buy that call, $9.75, and then let's say you hold that call for, let's just go 5 days. You're going to have 25 cents come off that, a nickel a day. Now, remember, theta is a bit of a moving target. It's going to change over time. So it's not going to be exactly 5. For the purposes of our analysis and our estimation, we're going to keep it at 5 cents a day. And now, so 5 days go by. Let's say nothing else happens in that underlying. It stays around whatever strike. Let's say it's near the 120 strike in our example here. Then you're just going to have that option sit there, and it's going to die a little bit every day. And 5 days later, you're going to have an option that's worth $9.50 with all other things being held equal. So you could see now why there's a bit of a ticking clock to your options positions, and also why we say if you're out there buying options, and I know a lot of you are out there doing that right now, the meme round 2 is kicking off. AMC is, God knows what the hell is trading at right now. It's off to the races yet again. So I know a lot of you are getting long premium out there, and you need something like an AMC to really happen. Maybe not to that extreme, but you need something to happen pretty quickly before enough time decay comes out of those options where you could end up stopping yourself out before the trade even happens, just because you've lost so much on the option due to decay out there. Now let's flip it around. Let's go the exact same way. Let's say now the option was $9.70 at $9.75. You sell it for $9.70. Now you're short that option, and your theta is positive. You're collecting that nice juicy nickel every day. Now let's go a little bit farther out. Let's say 10 days. Let's keep our theta decay constant again. Let's keep it right around 5 cents. So 10 days from now, all other things being equal, that option will have decayed 50 cents, a nickel times 10 days. And so you'll have an option that's worth $9.20. And it may not seem like a lot, but over time, that kind of stuff tends to add up. Dan, anything you want to add here about the flipping that sign of theta and how it may impact your portfolio and your trading, sir?
Yeah, I mean, look, one thing that I always like to say is I love to have somewhat of a mix of both, right? I mean, there's some people who really love being option sellers. They like that warm, fuzzy feeling of winning more than not. And then there's some people who love being option buyers and love that being able to have big winners on momentum and such. But to me, the answer is a little bit of both goes a long way. I love not combining those two strategies, but running them simultaneously. I don't feel like I need to be theta neutral or volatility neutral by any stretch of the imagination, but I like to be opportunistic and sell when things are overpriced and buy when they're underpriced.
Let's talk about being opportunistic a little bit. Let's talk about both sides of that coin. Let's talk about trades that benefit from theta and then trades that suffer a little bit from theta. You can probably imagine we kind of just broke down some basic examples of both trades that benefit from theta, trades that are going to collect on a little bit of time decay, or basically any short option trade. So the short call we just talked about, also the short put, single leg short options trades, also some combined trades like a short straddle, something like that. All of those are going to benefit from time decay. So every day that goes by, you're going to collect a little bit and you're going to hope that the underlying doesn't move. It sits right where it is and you get to this nice, easy income stream on these names. Doesn't always work out that way, but that's what you're hoping for over there. Also, spreads can benefit from theta depending on how you structure them. Typically, if you're going to structure them, remember we said the at the money is the strike with the highest level of theta decay. So you're going to want to have the short leg somewhere closer to the at the money than the long leg. So your basic verticals, for example, where you're selling a call, maybe an at the money call, buying an out of the money call. Maybe you're selling a slightly out of the money call, buying a farther out of the money call. The short leg is closer to the at the money. So you're going to be collecting theta in that situation. The same thing with the puts. You're going to sell the put that's closer to the at the money and buy the farther out of the money one. And so therefore you're going to be collecting your theta on that short vertical. Other types of short leg trades like short iron condors. Iron condor, of course, you can think of it as two strangles with one leg closer to the at the money, one leg farther out of the money. You could think of it a couple different ways for the iron condor. But basically, if you're selling the wings, the legs that are closer to the at the money and then buying the farther out wings against it, you're going to be collecting theta in that example as well. Short iron butterfly, same thing. Iron butterfly is just a short straddle. So you're selling that at the money straddle and then you're buying the wings, aka the strangle, to protect it. So in that case, you have a short straddle. So a short at the money straddle. So you're short two of the at the money strike there. So you're going to be collecting a lot of decay. So that will certainly benefit from theta. Also, some of your basic calendar setups. And we're talking about basic. We're talking about your very common going out. It's got 2 months, buy an at the money option, then turn around 1 month and sell that same at the money strike. Remember, you're shorter the strike that is closer to expiration. So you're going to be collecting some theta in that situation. Now let's flip it around the other way. Trades that suffer, that feel the pain of theta. Again, any basic long option trade, any trade where you're going out and buying an option, buying a call, buying a put, those are going to be suffering. They're going to be paying decay every day out there. Same thing with verticals and spreads that have the longer leg nearer to the at the money. Your long call verticals, you're buying an at the money call, selling a farther out the money call. You're long the strike that has the most theta on it. So you're going to be net paying theta on that. Same thing with a long put vertical. And same thing with long iron condors where you're buying the strikes that are closer to the at the money, selling the farther out the money wings. And long iron flies where you're buying that straddle. You're buying two of an at the money strike and then selling the farther out of the wing. Same thing. You're going to be feeling the pain from a decay. Also, the reverse calendar spreads. You don't really talk about selling the calendar spread very often. We talked about it a few times here on the show, but it's a very rare thing. It's hard for a lot of people to really wrap their heads around it. So we won't get into that too much here. And then kind of as Dan was alluding to earlier, there are some trades that kind of fall in the middle. And these are usually some of the more custom spreads where you can kind of choose your strikes, things like diagonals or collars where you're kind of playing with them a little bit. How far out of the money do you want to move the put? How far out of the money do you want to move the call? In the case of a collar or in a diagonal, where are your strikes lining up? And that could depend. You could be collecting theta. You could be paying theta. You could be kind of theta neutral if you're kind of equidistant on both of the strikes. So there's a lot of trades that also fall into that gray area. Dan, anything to add here on the trades that lose from theta, the trades that win from theta, and the trades that kind of fall in between, sir?
You know, I mean, I think the real most important takeaway from that is that there's always this inverse relationship between theta and gamma. And whenever I have theta hurting me because I'm long options, I always have gamma helping me. And whenever I have theta helping me, I always have gamma hurting me. So it's just this trade-off, and a fair trade-off, and you're just sort of making a bet on one side of that or another. And I think that's really key to remember. Like the theta haters, I never met an option I don't like to sell. That crowd. I mean, keep in mind that you have some disproportionate risk reward, and that may be worth it to you. And if you are a habitual option seller, it typically is worth it to you, and that's great. But bear in mind that is your risk. Movement hurts you, and it can hurt you more and more the bigger the movement.
Good point, sir. Yes, there is a trade-off in everything out here in options. And in the case of theta and gamma, they are, like I said, two different sides of the same coin. You can't really have a lot of one without a lot of the other. So if you're paying a lot of theta, the plus side of that is that you're set up for a big move in the underlying. You have a lot of gamma. So if that thing starts moving, you're going to make a lot of money. The flip side of that, if you're collecting a lot of theta, that means you're short a lot of gamma. So any little tick in the underlying is going to bring tears to your eyes. So again, there's no free lunch. Everything has a trade-off. In this case, you can't have a lot of theta without a lot of corresponding gamma, no matter which direction you're looking at it here. So just a quick revisiting. If you want more details, of course, you can always check out Dan's book, Trading Options Greeks. Check out the archives of this show as well. We've done a lot of basic introductions to the different Greeks. If you want a longer deep dive into them, Options Playbook Radio is another great one for you to sink your teeth into. A lot of sources for great quality information on theta. You know what else is great in quality and sometimes has good information as well? It's your questions. So let's get to them. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, let's do it. A little bit of the old mail call. Dan, we get so many questions for the show. People can't even wait for the next episode. Sometimes I have to route them to different shows because they're just burning up with their question. Just like this last one, Dan. Chase Bennett sent this in. He couldn't wait for the next podcast. So we actually discussed it yesterday in our pro Q&A session, but I want to give you a chance to chime in on this as well. Chase writes, "Hey guys, love the podcast. On a recent episode about rolling covered calls, you mentioned rolling when the underlying goes through the strike price. I will likely have this happen soon, but I still have 50 days or so till expiration. Can I wait a bit? I know you typically wait to answer on the podcast, but my underlying just went through the strike." Sounds like it's moving as he was writing this question, Dan. He says, "Can I wait till closer to expiration, or should I go ahead and roll? I would really appreciate your thoughts." Like I said, we touched on this a little bit yesterday, but Dan, I want to give you a chance because I know your MTM options income system is very clear about what happens when you break through the strike. So what do you have to say here for Chase and everyone else who has a similar question about what happens when the underlying goes through the strike? We still have a long time to go on that call, Dan.
Well, there's a couple of things here, Mark. I mean, one is I usually, not always, prefer to sell shorter term options, Chase, because that goes back to what I was saying. Typically selling 4 1-week options makes you way more than selling 1 4-week option. Now, sometimes it's a situation where it does make sense to sell somewhat longer term options. I was just looking at my AT&T stock in my IRA, and I was like, yeah, a longer term option makes a little more sense here. So I don't know, like to me, that's a little bit of something to take a look at going forward. And one of the other reasons why I like selling shorter term options, not just that the theta is higher, but then you don't end up in a situation like this. Like I've got almost 2 months and I'm already through my strike. Like, what am I supposed to do now? Right. So you've probably been collecting this real low theta because it's long term. It's maybe going to go through your strike. And now if you're going to roll, you either buy it back, maybe for a loss because theta was so low. If you can buy it back for a break even or better, or even a small profit, I love the idea of rolling. I mean, totally do it, but I sure wouldn't go out further in time. My rule is if it goes through the short strike, roll it. And I would just simply roll it up to a higher strike and stay within that 50-day range.
Yeah, that was my takeaway on this as well. Is what are you doing writing options that far out? We just talked about maximizing your theta, right? And you're not maximizing it by doing that. I get it. There are some reasons people like to do it. You mentioned your AT&T and your IRA. You're not going to probably touch it for a while. Sometimes financial advisors like to do this. They write quarterly calls because they just want to set it and forget it, and they don't care. So you could be in that camp, Chase, but it sounds like you're not because you're watching the underlying and you really want to roll it. So you probably would do better, and it probably would behoove you to look at shorter dated liquidity, certainly a month, if not less, out there. So if you do that, you don't have as much of this problem because you can readjust on a more regular basis. If you're doing the weeklies, you can do it many times before you get to this 50-day period. So yeah, that's the first advice I would definitely give is migrate shorter. And definitely, if you sounds like you want to roll. So by all means, go ahead. Next up, we've got Rick. Rick says, hey guys, loving Options Bootcamp. Well, we love you, Rick, and everyone else who takes the time to write in. He says, I don't think I've heard you talk about SPACs. These are, of course, the special purpose acquisition companies, listeners. He says, are they big options players? Do most of them even have options on them? Are there any pitfalls or dangers about trading options on these things? Thanks so much. Yeah, SPACs, you're right, Dan. We haven't really talked about these on the show, Dan. They're kind of the flavor of the month a few months ago. It seems like they have waned a little bit. I think the regulators are taking a second look at these as well as kind of being a bit of a backdoor way into an IPO. Some of them have a little bit of fervor around them, but for the most part, a lot of them weren't huge options players. Dan, can you recall people coming into your MTM and trading up a ton of these SPACs, or?
I mean, no, not trading up a ton of them, but I mean, SPACs are pretty interesting. I just put out a video. Everybody who's on my email list, who subscribes to our newsletters, typically about 3 times a week, I send out a complimentary video. And man, just last week I did one on SPACs. They're a great way to sort of get into in maybe a brand new industry pre-IPO. Like, for example, one that I got in was flying cars, right? I go out like to have dinner at a friend's house and tell them, hey, what about flying cars? They look at me like I have 3 heads, but no, like that's one new industry, eVTOLs, that is happening right now. And I wanted to get in before the IPO because a lot of times when the IPO happens, it kind of runs up and it's oversubscribed. And by the time you get in, it's already priced out. So I love doing it. Sometimes you can do it the way I did it with Quell, Qell. It's a little bit late for that. They already announced their merger. But I bought some leaps, 5-strike calls when the stock was at 10, and I bought them for like a nickel over parity. It's like, okay, because there is risk with SPACs of, deals just not working out or whatever, I figured, hey, look, if this thing goes to zero, I have a put that I paid a nickel for. Big frickin' deal. So, yeah, I mean, there's a lot of technique to it, but I love them. I really do. I love them.
Yeah, I think the standard caveat applies. A lot of these are not going to be as liquid. If they are optionable, you probably have to deal with some wider spreads. Sometimes you get deals like Dan was talking about there, but those are few and far between. So I think any typical caution you would have with trading a less liquid name would also apply to a lot of these SPACs. And also there's a huge question mark over the actual value of the underlying, right? There's an intent to acquire something and go public, but is it going to happen? We don't know. So there's a lot of question marks hanging over those names, but separate that stuff out, separate the underlying risk just from a purely options perspective. I think any caveats you would have about trading a less than liquid name would typically apply to a lot of these SPACs. So just be cautious out there. But if you can get good fills, like I said, Dan was looking, if you can be judicious and get a decent fill, it's like trading any other underlying, just probably a little bit less liquid out there. We got so many coming in here. Dan, let's see how much time do we have left. We got time for a couple more. Let's go to Jacob here. Jacob Stoker, Dan. He says, hello, I'm a big fan of your podcast and have been listening to many of the episodes. Many times I hear about laddering into positions. When it comes to laddering into a short straddle, do you have to worry about inversion because of these different laddered entries? Well, I wouldn't intentionally be inverting positions. As the market moves and I buy additional positions, I would think it could be natural to have the puts priced higher than the calls at the same expiration date. I think I am missing a fundamental piece of understanding and my thought process. I appreciate any insights. Thanks, Jacob. Well, Dan, a lot to unpack here in this question. Maybe you could spend a couple of seconds really quickly explain to the listeners what the heck he means by laddering, and then he specifically wants to ladder into short straddles. So are you worried about maybe the calls and puts not exactly lining up in that situation, sir?
Yeah, Mark. So, I mean, there's a couple of things that I'd like to comment here. I mean, first, I'm usually not a huge fan of selling short straddles, only because I like to be a little bit more conservative. I'd rather sell like an iron butterfly with wide wings just so I have some of that protection. Because, you know, the black swan comes and he's an unforgiving little bugger. So I don't know. I mean, I just want to throw that out there. Have I ever traded a short straddle? Sure. But I like to be pretty careful. That can, you know, you're just one crazy world event away from big trouble. But that said, laddering is a potentially good strategy when you do it in a pretty controlled way where, especially if you have a bigger account and you don't want to just go in and sell like, you know, 500 of these straddles and move the market and create some waves. So what you'll do is maybe you'll sell 150 straddles and then a week later or 2 weeks later, whatever it is, sell another 150 straddles, and then 2 weeks later, sell another 150 straddles. So you're kind of flying a little bit more under the radar. I don't like having more than 3 different, let's say rungs on the ladder. You know, I don't like, let's sell 5 today and 5 tomorrow and 5 the next day and 5 the next day. You know, like that starts getting crazy. But one of the nice things about doing that also is that you get to adjust the strikes, which I think is where this question is going to. So, I mean, I don't know. For me, as long as you're not putting more than 3 rungs on the ladder, you might not run into that problem very often where strikes are kind of conflicting and it's getting weird. I don't know. I mean, unless you have like a really, really big account where you're going to move the market, I mean, I like just being more decisive and just saying, here, I'm going to sell my 10 lot straddles and I'm going to buy them back lower. And then later I'm going to do it again. And, you know, just kind of keep it more like that and skip the laddering. But it's very situational. I guess we'd have to dig into the weeds a little bit more and really see what the best ideas are.
Yeah, so Jacob, if you want to send in more details, what underlying you're looking at, because obviously if you're doing different positions on different days, yeah, your straddle is going to be priced differently. So you're worried about the puts being over the calls. That could be the case. Some days the calls are going to be over the puts. Remember, as you start rallying, the calls are going to rally, puts are going to drop, vice versa the other way when you're looking at the straddle. So depending on how long you wait in between positions, how much movement there is, yeah, you're going to have times where they're not exactly both trading, let's say $5. One could be trading 7, one could be trading 450. You don't know. So if you need to have both of them at the exact same price for some reason, you're not going to get that if you're laddering in. So if that's a concern to you, then maybe you put it all on at once when it all really makes sense for you. But again, give us more details, what underlying you're talking about, why you want to take this laddering approach versus doing it all at once, and then we can provide you a little bit more insight. Unfortunately, listeners, that music means we've come up against it for this episode, but a lot more coming at you. Even later today, you got Options Playbook Radio coming at you with Brian a little bit later today. That'll be hitting the podcast feed a little bit later today. Easy for me to say. Tomorrow, we got your second dose of the option block as well as TWIFO. This week in futures options, breaking down some fun stuff there, Friday volatility views. Then it all kicks off again next week on Monday, all the way through to another Education Wednesday and another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.